is for living.
All right, good morning. We have to talk about mortgages yet again, and we need to talk about mortgage rates because I've covered this already a lot on the pod, on the YouTube channel, certainly. But this is just a story that just keeps on giving, it just keeps developing. And what I want to do is obviously keep you guys informed of what's going on so you can make better financial decisions. That's the whole point of the podcast. That's the whole point of the YouTube channel. And so I'm just going to go over some of the key points that have now come to light. And I want to talk a little bit about the wider problem as well, because I have a real concern that people are not going to be able to pay their mortgages. People will end up losing their homes, and people aren't just going to be able to survive, period. And I hope by the end of this episode, you feel compelled to act, to do something now in opposed to wait. And hopefully, you'll be in a position where you can just take the next steps that you need to. I don't know what your next steps will be personally, but I just want you to get value from this. So let's just do a bit of a recap in terms of what's happening at this point in time. So we know that the Bank of England base rate increased again from 4.25% to 4.5%. And over the past couple of weeks, we've been hearing a lot of murmurs that because inflation hasn't been coming down quick enough, we're likely going to see mortgage rates, or the Bank of England base rate at least, to start off with, move to 5.5% from the 4.5% that it increased to at the last rate hike interval. Now, there are now other sources saying that we might see 6% rates, but this has a direct impact on things like mortgages and some of the staggering numbers that we've seen. So I've mentioned on the podcast and on YouTube before that 1.4 million households are going to be coming out of their fixed rate deal over the next 12 months, right? I'm actually one of them. My mortgage comes out in August. I'm at 1.49 right now. I don't know what I'm going to be going on to, probably over 5%. And millions of other people are going to be in this position. But that's just the next 12 months. In 2021, at the beginning, well, during the pandemic, not necessarily at the beginning, but during the pandemic, if you recall, the government introduced a stamp duty holiday. And that was to encourage people to buy new houses and obviously not have to pay stamp duty. And a lot of people would have done that. And unfortunately, a lot of people who may have done that during that period of time will either have fixed maybe for 2 years, which will be coming up right now. So they'll be going on to higher rates given where we are right now. But even worse for first time buyers, and this is the real painful bit, they've probably gone in with a relatively low deposit, 5% deposit to a 95% mortgage, and a 90% loan to value, or a 10% deposit mortgage. Now, let's have a look at the market, the housing market specifically before we get into the detail of this. So these are some stats that are out there right now. Now, the most important one, or one that stood out for me from the Bank of England, was that in April 23, we saw mortgage borrowing fall at its lowest level since records began in 1993. According to Halifax, May saw the sharpest fall in house prices by 3.9% since 2012. Since 2012. Overall, from the peak of the property prices in August 2022, house prices are now down 10%. Now, there is an argument here that first time buyers, purchasers will be happy here. And we can talk about that maybe in a completely different episode. But I do want to talk about this just from a mortgage person's point of view. If you own your own property right now, the reason why we're seeing so many moves and such a move within the property market and housing prices is because of the fact that, well, inflation is still very much entrenched in our economy. And this was the fear that the guys at the Bank of England and a lot of economists had. When they normally measure inflation, what they're doing is they're taking a basket of goods, and to a certain extent, they can manipulate that because they can choose to include certain things in that basket. What we're now seeing is that even when you disregard or even include the basket of goods, core inflation isn't moving. And core inflation are the things that actually, outside that basket, you're still paying a lot of money for them. So we're seeing that increase be entrenched more in our economy. And that's what's spooking the Bank of England, with them basically saying they're going to have to push rates up even higher. And a lot of the rhetoric that we've heard from Jeremy Hunt and the government over the past month or so is unnerving, because Jeremy Hunt is on record saying that he will support the Bank of England pushing interest rates even further. And so it's this concoction of things that I guess is just a bad combination, which leads to the problem that we have at the moment with mortgage rates and the fear that we have. Now, here are just some stats for you. Okay, so it is now rumored that the average 2-year fixed rate mortgage is now at 5.89%. That's the average 2-year fixed rate mortgage. An average 5-year fixed rate mortgage at this point in time is 5.19%. Now, that may not mean anything in terms of that how that translates to monthly payments. Well, let me just help you. So, assuming you had a mortgage of £300,000, a rate of 5.89% for an average mortgage on a 2-year fixed rate deal would mean that you're paying an additional £650 more per month than what you're paying currently. It's a very, very scary time right now. And whilst these numbers are extremely scary, there is another side to the coin, a flip side to the coin. And that is that if you're a person looking to get on the property ladder, you're hoping that this will lead to a housing crash, a housing market crisis, right? Where property prices tend to fall. And that could be a good thing. But it may not be a good thing when you consider the entire situation and how the housing market basically has ties to our financial system and the wider economy. We see house prices fall because people start to default on their mortgages, and this is going to be a really big risk. I mean, I don't know that many people who can afford an additional £650 per month. It is rumored that over the next 12 months, up until 2024, and the average household is going to have to pay an additional £2,900 per year for their mortgage. Just let that sink in. £2,900 in additional cost for the average household in the UK to keep their house and to keep their mortgage. And that on its own may be something that you think you can cope with, but we're not factoring in energy costs, food cost, fuel cost, inflation. And when you look at the combination of all of these things, this is where you get into the real concern that people are not going to be able to afford their mortgages and all hell breaks loose. Now, if we see a property crash, yes, people start to default, people start to sell their homes. It may be beneficial to first-time buyers, but what that basically means is that there is a threat to our financial system, our financial stability. That can have a knock-on effect to the economy. If the banks aren't there or losing money, what does that do for other businesses? And so you may think that it's good news, but on the scheme of things, there may be an impact on your job. There may be an impact on your income. There are so many permutations of what could happen and the possible effects of this that I guess we'll find out when we get there. I mean, do we pause it and speculate these now? I like to think not, because let's think on the bright side, right? And I'm not just saying that because I'm a homeowner. I'm in a lucky place, fortunately. There was another stat that really stuck out to me, and this is also something that goes to tell you how impacted the mortgage market has been. So in April of this year, people overpaid their mortgage in the UK by the tune of £1.4 billion. That is more than what was lent that month in mortgages. So, in other words, the mortgage market is also starting to shrink. And for those people who do have mortgages, I know that I'm certainly considering now making a lump sum overpayment to my mortgage when it comes up in October, and starting the wheels and getting the wheels in motion for that right now. So, look, what does this all mean, and what should you do? I'm still getting a lot of people asking me questions about whether I think that interest rates are going to return to what they have been. And I've said this a number of times before on the channel, on the podcast, on other people's podcast. I don't think that we're going to see interest rates back at these historic low levels, 1.49%, 2%. I think the new rates are going to be, 5, 6%. I think that's just effectively what we're going to see now. And I think we need to be prepared. And I think that we need to be equipped to deal with that, because if you're not, I don't want to think about what that basically means. And there are lessons to be learned in this as well. And one thing I've always said across the podcast and the YouTube channel is we are going to be in this kind of situation before. The last time we were here was what, 2007, 2008. It looked different, it felt different, but ultimately people were squeezed back then because markets crashed, the property market crashed. This is just another iteration of that on the cycle, and we will be here again at some point in the future. It may be 10 years from now, 7 years from now, it might even be 20 years from now. The important thing is, what do we learn now to put us in good stead for the next time? And I think this is the key thing. And look, if you do have a mortgage right now, I have to encourage you, I compel you, please go and speak to your mortgage professionals. I don't care whether you go to your lender directly or whether you go find an independent mortgage advisor. You need to be proactive and you need to be speaking to a mortgage professional right now, particularly if you have your mortgage coming up in the next 6 months. You can secure a rate right now. And let's just assume that by the time your fixed rate actually comes up, so let's just say it ends in December, and you've been able to lock into something like 4.79 or 5.4 right now, which I know sounds high compared to where we have been. But if it turns out in December that actually rates have come down, then you'll be able to get yourself onto one of the lower rates in the future. What I'm saying is to be proactive now and try and see if you can lock in a rate right now before rates start to go up. A lot of the banks last week, HSBC is a prime example of a bank that basically said they were going to pull all of their mortgage rates because they can't deal with the demand. They can't cope with the demand, and they came under a little bit of criticism. They U-turned. They didn't pull all their rates. But I think this is something that we're going to continue to see until we know for sure what is going to happen with interest rates. But whilst there's all this speculation, it's not going to be a good thing. We are going to see mortgages being pulled off the market. We're going to see rates that are based on the best guess of what's going to happen next at the next Monetary Policy Committee meeting at the Bank of England. I will report on that once the meeting has happened, and I think we're going to see another rate rise. We're probably going to see a rate rise to 4.75 or, God forbid, even 5% at this next meeting. I'll report on that as when we get there. But please do not wait for that to happen before you start speaking to a mortgage professional, because if you do, you are going to find yourself in a position where you've missed out on a better rate than what is going to come down the track. And I'm saying is going to come down the track, because if you had to place a bet on this, the propensity that we're going to see a rate hike is probably in the 90, 95, high 90% quartiles at the moment. So be proactive. Don't sit there twiddling your thumbs. Get out, go look at your options, try and understand what you need to do in order to make that happen. That's it. I wish it was better news. I wish it was more of an upbeat type of episode, but this is a really important one for us to make sure that we get right. And I want to make sure, I want at least want to hope that you guys get right, and I want to help you get this right. So please go speak to a mortgage professional if you're in this position right now. If you're a renter, you're probably seeing your rents increase. And look, I'm sorry. It's a difficult one. It really, really is. I posed a question on Instagram the other week asking whether landlords, as they're seen historically, and property investors, who benefits out of this rate hike, who benefits out of this whole situation. And the results were interesting to say the least. And it just says the power of social media. You know, this new term, property investor, is a lot sexier than landlord, but essentially property investors are landlords. And look, it's a very, very rough road ahead. Please be prepared. Again, in my book, The Money Basics, I cover a lot of the financial principles to help you lay those foundations. If you've not picked it up, you can scan the QR code right here if you're watching on YouTube. If you're listening on Spotify or on any of the podcast outlets, there'll be a link in the show notes. Enjoy the rest of your week. And look, stay tuned. I'll have more information as and when I have it. And hopefully you found this useful. Catch you later.